So recently, CalFHA launched their new program called the Dream for All program. And this program is designed to make it easier than ever for first-time home buyers to buy a new home. I'm going to go into the details on how you can qualify. Stick around. Okay, so the first thing I want to talk about just real quick is that this is not a pre-approval to go buy a house. I'm not saying that based on everything that I'm telling you today that you are qualified to go buy a home, and any numbers that I go over are going to be completely hypothetical. They're just for you to understand how the program works. The other thing I want you to know is that these guidelines on programs like this, and really all programs, they're constantly changing. They're always moving. This is why Google is not a great resource for you to go find answers, right? You can get an overview of the way things may look and the way they looked at that period of time. But you have to understand that guidelines are always changing and they're always subject to what the lender wants to do and how tight they want to be around those guidelines. So they'll follow certain guidelines and then they'll have like overlays. Like this is the guidelines, but in addition to this, we also want this thing here. Okay, so those things are changing all the time. So this is just an overview of how the Dream for All program works based on today and based on my understanding of that program today. Okay, now that that's out of the way, let's talk about just what the program really is. So this program is really designed to be like a down payment assistance program. And not only is it down payment assistance, meaning they're going to help you with the down payments, it's also a shared equity program. Okay, so let's kind of go over what that looks like. So I'm going to give you just kind of a scenario, okay? And the scenario would be that you want to go buy a house for $100,000. Okay, now, real quick, you are not buying a house in California for $100,000. It doesn't exist here. Just numbers I want to use to keep them round so you can understand them. So in this scenario, let's say you want to buy a property for $100,000. CalFHA, what they're going to do is they are going to give you 20% of the down payment amount. They're going to come in with the down payment amount. It's not like forgivable. It's always going to be attached to the property. It does have to be paid back, but you don't have to come out of pocket with that. So whenever you buy a house, you always have to have some sort of down payment, generally speaking. In this program, what CalFHA does is they're going to give you 20% to put down the property. So if the property is $100,000, they're going to give you $20,000 to put down, which means you are going to have a loan for $80,000 to balance, right? So let's just recap. You buy a house for $100,000, you're going to get $20,000 from CalFHA, and then you're going to have a mortgage, a regular mortgage for $80,000. And this is the number that you're actually paying on. So you're getting kind of a second loan for $20,000 from CalFHA that you're not paying on. It's just sitting there and it's used as the down payment money. So here's what's great about that. If you were to buy a house and you were to buy it and put down 3.5% or 5%, in that scenario, you would be paying on, let's say, 95% or 96.5%, right? So your payments are on a bigger portion of the property. Now, when you have 20% down, you're only paying on 80% of the property, which means your payments lower. So the benefit is that you are now only paying on 80% of the property's value or the purchase price, and you're not having to come up with any down payment money. In addition to the down payment money, and then also the loan that you're going to have, there's also closing costs. And closing costs are things like title fees, escrow fees, prepaid taxes, insurance, these types of things. Usually it's around 2 or 3%. But the point I'm trying to make is that when you buy a house for $100,000, it's not going to cost you just $100,000. It's probably going to cost you $105,000. It's going to be a little bit higher, meaning you're still going to need some money for the closing costs. Okay, so here's kind of the downside. So because this is a shared equity program, what happens is when I sell the property, I actually have to pay back the $20,000 plus 20% of the equity of the property when I sell it. So let's run through that a little bit, okay? So in this scenario, we bought a $100,000 property and CalFHA gave us $20,000 to put down, okay? And we've been making payments, let's say for 5 years. Let's say 5 years later, we've been making payments on an $80,000 loan amount. And after 5 years, all of a sudden, because we've been making these payments, our loan balance is only maybe $60,000. And we're like, you know what? it's time to sell the property. We want to move out of state because California, they tax us to death. So you want to move out of state, and your loan balance is only $60,000. And let's say that in 5 years, the property value has gone up to $200,000. Now that's totally unrealistic, but I want to use round numbers because it's going to make life easy for all of us, me especially. So property goes up to $200,000, and we owe $60,000 on the mortgage. So that gives us $140,000 in spread. We've got $140,000 in equity. So we sell the property and we take in $140,000 cash. Okay. Now with that $140,000, there's a couple things that have to happen. The first is we have to pay back the $20,000 that we borrowed, right? Because we got $20,000 for the down payment. So that has to go back to CalFHA. So $140,000, we give back $20,000, and now we have $120,000 in cash that we've gotten from the equity of the sale of the property. Of that $120,000, what CalFHA wants is they want 20%. So 20% of $120,000 is at, what is it, $24,000. So CalFHA gets $24,000. 120 minus 24 leaves $96,000 for us. So now we've got $96,000 in equity. CalFHA has gotten their $20,000 they've given us as a deposit, or down payment money, and they've also made 20% of the equity from the sale of the property, that $24,000. So overall, there's a ton of benefits to this type of program, right? You're able to buy a home with almost nothing down. You're probably gonna have to come up with some closing costs, but that's just kind of part of the, part of being a homeowner, is that, you get to pay for things. So, you'll be able to get into a property for less than you normally would. Of course, you got to share the equity when you sell the property, but you may not be able to buy a home otherwise. And that's what they're trying to do. They're trying to make home ownership more affordable for California residents, and that's exactly what this does. So a couple things that I've been asked on my Instagram. The very first thing is what happens if you default on the payment or the property value goes down? Let's just say, let's run the second of those two scenarios. Let's say property value goes down. Let's say you've borrowed $100,000, but in 5 years, the property is only worth $90,000. Well, that would just be like being upside down in any other type of mortgage. If the property value goes down and you owe more than it's worth, you're not really able to sell unless you want to kind of pay it off. Think of it like a vehicle, right? Let's say you buy a car and you've been driving this car around for a while, and then you want to sell it and you're like, well, I owe more on the car than the car is actually worth. That puts you in a negative equity situation, and then you wouldn't be able to sell the property. Or if you did sell the property, you'd basically have to come to the closing table and write a check to pay off the balance. And there's also some eligibility requirements. So the first thing is you have to be a first-time home buyer, okay? And there's definitions around that, and I'll put a link in the bio to where you can read the definitions. The other thing is that there is income limits. Okay, so this program is not designed for people who are making, like, as a household, like $200,000 or $300,000 or $400,000 a year. Okay, it's by county, so every county has a different income limit. You have to be below a certain limit, okay, which means you can't make too much money. If you make too much money, you won't qualify. I will also put a link in the description so you can see what those limits are by county. The other thing you're going to need to do is you're going to have to take an 8-hour online first-time home buyer course. It's like $99. I don't think it's very difficult, but it is a requirement to get approved for the program. And then lastly, you're going to have to go to a lender who is approved by CalFHA, meaning not every single loan officer does loans for this type of program. And actually, I'm not even one of those lenders. I do have some people I can recommend to you. You can send me an email and I can refer you to somebody who can help you out, but I'm not one of those people. I'm making this video just to provide value to the community. If you have any questions about this program, go ahead and throw them in the comment section. I do my best to answer those questions as quickly as I possibly can. Don't forget to like and subscribe. That's like the best way you could show me some support. I do my best to provide a ton of value on this channel, and it would be awesome if you could just support me back by doing that. I appreciate you guys tuning in. Thank you guys, and God bless.